Akshay, you have to wait for the budget to get out. You have to wait for global cues to settle. If directionally things on the FIs selling is going to be so large, then everything will get crushed. It was a rising tide phenomenon. It's a receding tide phenomenon where good and bad stocks, they both will start getting chopped. You will see stability coming back now. Let the market discover some degree of stability. I think right now there is volatility. Volatility is that you cannot understand and judge where things are moving. I mean, I was just looking at the screen right now. Everything is getting painted with the same brush. United Spirits, fantastic numbers, the stock is still down. I'm looking at Raymond's, no reaction to good set of numbers. So this market is in a mood where you're getting punished and you're getting thrashed irrespective of what the delivery is or what the underlying bent is. I go back to that same point again. The rate hike cycle from 2015 versus 2022 is very different. We are in an economic recovery curve, but your valuations are stretched. The economy is a much more resilient manner, but crude is going to spoil a lot of macros. Aditya Narain is ready. Aditya, what are you telling your clients? Just brace it out, be patient. I mean, there's no other way but just to perhaps digest the pain.
See, I think there are two ways of looking at it, right? One is to react on a day-to-day basis, which is what is happening with the market at this point in time. The other is to sit back and say, okay, what are the risk sets out there for the market for the next 6 to 12 months, and what are the upsides for the market, right? And the call that we have taken, and we did it with our year ahead piece, was that this is going to be a year of a what if / can be kind of year. The what ifs being the risks, which is what is beginning to actually play through at this point in time. And the can be is some of what you're seeing in the good results that have come out from a handful of companies, right? So our view really is that at the end of the day, this market is going to be up and down during the course of this year. Our target for the end of the year is about an 18,000 on the Nifty. And to that extent, if you see the market going off meaningfully more from here, it starts becoming attractive. If it starts bouncing back in a hurry, then you need to settle down a little bit, right? So that's the way I'd see it. Rather than reacting from an immediate perspective, I do think it's going to be a difficult year. As you mentioned earlier, this is not a risk that has not been flagged, but the reality is when there's general optimism and a risk starts actually playing through, then it has a little more of an impact.
The FI selling, I guess, is now getting multiplied. It may sound like a tactical trade, but there is just no disregard for growth or numbers. HDFC Bank, Bajaj Finance, they are just getting clobbered. Can I say that one should avoid FI dominated stocks at least, because you will get maybe 5%, 10%, 15% lower as the selling unwinds?
But again, I think it's a question of looking at it from a shorter term and from a medium term. The reality is if you're going to see continued foreign outflow of the nature you are seeing at this point in time, then it is going to be the heavyweights, the more FII invested stocks, where you're going to see fundamentally more pressure. So to that extent, if the call is, FIIs are going to continue to go out for a period of time, then that's where they're going to be. And that the belief there also will be that the impact cost will tend to be a little less, even though, given the way stocks are moving, it's not that limited. But again, I think what you need to be very watchful about is a reaction to a kind of an event, right? And the other part of it is what are the longer term implications of that, right? So at this point in time, I think it's still really focusing on the event. There's not enough thought being given to how this will play out for the economy over the medium term.
Event which is at play. Nikunj has already asked you what you're advising clients. Now the other way to also look at it is that is this maybe a time to maybe buy into regrets as well, or is this a time to take cash off the market? Where do you stand?
I think in many ways, the way we were seeing it was that the last year was a bull market. The next year could be a bull market. 22 is unlikely to be anything of that nature, right? So if you're looking at finding stocks where you think the rest is in order, which is whether it is the economic setup, whether it is the earnings growth trajectory, then this would tend to be a relatively decent time to buy stocks. So we wouldn't rush to get off the table at this point in time. As I said, this is an event that had been flagged and there is a bit of a reaction to that. People had invested knowing that this risk was there. So we wouldn't advocate taking money off the table at this point in time. But what we would say is that the next couple of months will be a little up and down. So it's not as if the base is necessarily made at this point in time. But yes, wherever there is comfort with a stock or a sector and you're getting more attractive prices, then this is as good a time as any to start dipping your toes in that space.
So then, with that, Aditya, can I ask you what is seeming attractive at this point?
Well, I think so. There are two areas that we think, or two sectors where we think there is a very decent upside from a business trajectory perspective. Right. The first is the technology space. These stocks have now got pretty badly hammered over the last couple of days. So I think there is a much greater value that you're getting at this point in time in that space. So there, as I said, I think at many levels, the growth paradigm is set for a couple of years. We don't believe that their demand or their growth is going to be impacted by a switch in interest rates globally, right? So here you have a situation where the outlook is good, the pricing is getting attractive because an overreaction to rate changes, which will not impact the business. So I think that's a space that I think that is that has become much more attractive at this point, given the kind of erosion that you've seen in values there. The other space where again we see very decent absolute returns is the banking space, simply because you've probably crossed the hump from an asset quality perspective. You're beginning to see loan growth come through, and valuations in a traditional context are relatively moderate, right? So that's another place where we tend to believe that there is very decent return that you can get. And there would be stock opportunities that this event is tending to throw up. The third part of our portfolio, which we've typically positioned, is really on the consumer staples perspective and the two-wheeler space. That is more in an overall portfolio construct where we believe it's good to be defensive, and some of which is playing out at this point in time. But in terms of absolute returns, in terms of this being a decent buying opportunity, I think they lie primarily in the technology space and in the banking space.
Interesting. Aditya, just taking a leaf from what you said just now, and I just wanted to understand, with the two big events ahead of us, you've got the union budget and then soon after the RBI policy as well. What is it that the government can do at this juncture to try and poise the fiscal as well as monetary policy to try and wade through this global storm that we're currently being swept in?
Firstly, and that's important, I don't think the Reserve Bank or the government should be reacting to an event like this, particularly, given the short interval that we've seen at this point in time. So I think that the budget should really be, and monetary policy should be looking out actually much further beyond. It will distort itself if it is just reacting to market events and to some changes from a rate perspective, which have not come from out of the blue. So I think that's the first part. I think as far as the budget is concerned, I think the good part is this year has been a good year. This is after years that they've actually beaten targets. But I think the cautionary element there is that a lot of it has come through price growth rather than underlying real economic activity, where it's grown, but it's been much more modest compared to the nominal bit. So this puts it in a little bit of a challenge, wherein you've contracted your fiscal deficit quite substantially this year, but next year you might not have the legs to bring it down in the same manner. So I think it will be a little bit of a task. We actually thrust, just reacting to the economy rather than necessarily to the markets. The first is you're going to see a little bit more of an emphasis towards rural spends. There's been a lot in infrastructure, you need it to sustain it, but the incremental shift needs to be a little bit towards the rural side. I think the second thing that I think we're increasingly expecting, I think that's good from an overall perspective, is to just come in with some urban employment support kind of a setup, which provides you a complete cover of the bottom end of the economy. You've seen it with the farmers, you've seen it with Narega. If the urban bit comes in, I think that provides you a bedrock for support in the broader economy, right? So bottom line, from a government perspective, I don't think they should focus too much in terms of reacting to what's happened. rather look at the balance in the economy and of course ways to effectively grow, right? I think when you come to the RBI, it's probably a slightly harder task, simply because they have to take into account what's happening globally, and the dependence on money from global quarters makes that more current and more immediate. I would say there is going to be a harder place. I think they've taken the right call by being easier with monetary policy and with rates so far. They've been lagging the developed markets, but the sharpness with which the US is reacting now, could compel it to be a little bit more hawkish or a little less conciliatory than it has been, which can be a little bit of a challenge. So I think with monetary policy, there is a little bit more of a challenge because you need to react more directly to what's happening globally than is the case with the government.
So prima facie, Aditya, how would you explain the global market price action right now? Do you think that in a synchronized way, global equity markets across the board are just trying to align themselves with the interest rate trajectory change and days of easy money and cheap money getting over?
See, again, I think we discussed this. I think the issue is what is expected and what is happening. As you yourself said, this does not come from out of the blue. The dot plot is continuing to follow in the same manner. So to that extent, it shouldn't have been the kind of shock that the market is tending to see at this point in time. I think what is coming into play at this point in time, which has not happened in the past, is that equity valuations at market levels and at stock levels have tended to be much more elevated compared with previous interest rate hike cycles, right? And I think that is where you are seeing some of, call it the froth, or some of the overvaluation, or some of the rich valuations, which are tending to come off. And I think that is where there is a problem, which extends to India also, because good as the results are, India is trading much more expensive in terms of what has happened with stock prices. I think what is also very interesting to note is that this talk with the Fed in terms of raising rates potentially more aggressively is also coming on the back of a very stated view that they have put forth, which is that the economy today is doing much better and it's much stronger than you had in past rate hike cycles, right? So that is why there is both a necessity for them to probably be a little bit more aggressive with their timing and their scope, right? But there's also a greater cushion that you're not going to overstretch yourself simply because there's so much momentum on the underlying, right? So I think that's where it's coming from. As I said, the global economy is actually in much better shape than it has been at any point ahead of a rate cycle, and valuations are thickish or richish. And that's where some of this rub-off is happening. And to some extent, that's a risk that India also faces. In fact, to some extent, India's growth cycle has been a little softer than what you've seen globally. And that's why the RBI has played it softer than the other banks so far, which could accentuate the risk a little bit with India's monetary policy, in that it's lagged. And if the US is going to be as extreme as it is being, then the catch-up might have to be quicker.
So Aditya, what happens next? If growth is there, the entire argument which is in favor of value stocks, is that a valid argument? The entire argument against growth stock, is that a valid argument? Because it's not that value stocks are cheap, and it is not that growth stocks have not corrected. Now I can argue and say, look, growth stocks in 2021, they were dirt cheap. Now they've made a comeback. SBI is not at 250, it is at 500 plus. Similarly, Naukri, I'm just using that as an example, or InfoEdge or India Mart, they're off by 25 to 30% from the recent highs.
So I think if you look at trends, right, a lot of growth stock valuations, particularly where the growth is in traditional businesses or the expectations are conventional, right, which is what you're seeing with some of the tech stocks. in those circumstances, I think the reliance or the correlation with what happens with global monetary cycles tends to be stronger. We've got a chart which shows that global balance sheets, they expand and these stocks move up a lot, they contract and they come off very dramatically, right? So you have that situation where it's not just growth, but it is the nature of growth that is tending to make a difference, right? And I think that's where they will be more vulnerable. The stock names that you took domestically, to some extent, you strip out what's happened with the Fed's move yesterday and look at what's happened to tech stocks in general in the Nasdaq over the last 2 weeks. They are tending to mirror that a lot more. So bottom line is, I think growth stocks, particularly where they are aspirational growth stocks, I think the risks are going to be higher. And as a strategy approach, we've actually kept them as underweights, right? When it comes to value stocks, I think you will get more cushion in those places. Like, we talked about two-wheeler stocks. I think that's where you get more cushion rather than necessarily a huge upside. But if you were to look at a situation where you are going to see this uncertainty, then high growth stocks where, as I said, the nature of growth is atraditional, I think they will be more vulnerable, and the support you will get will be value stocks or stocks that are closer to value, right? There's hardly anything that you find in India today that is value in absolute terms. But stuff that is closer to value or stocks that have come off without any structural challenge with their business, I think that's where there will be more push. See, a lot of this, these are all top-down events that are happening, and I think you have to view them a little bit more top-down. The call has to be a little bit more top-down than necessarily bottom-up, saying that this stock has come off so much, so we should go and be aggressive there. It is, mind you, it is going to be more of a top-down market than a bottom-up market over the next couple of months. It's only when absolute valuations come off a lot that I think it's going to be one where you're going to become more aggressive picking it up just for it.
Right. So it's a top-down market more than a bottom-up one. The momentum which is shifting towards value stocks as well. Tips on how to ride this kind of volatility and uncertainty that you're seeing around the globe. Thanks so much, Aditya, for joining us live today and sharing your thoughts as far as the equity markets go. Now we're in the thick of earnings season, and you've seen Macrotech Developers, the owner of the brand name Lodha,